Hey, this is Stock Bro from the Bro Pit. Everybody was wondering, why was trading restricted? I certainly did. I had a huge moan in a video I think I posted on last Wednesday, where I was like, I tried to buy GameStop at $200 in after hours trading, and I got a message from E-Trade saying, we are no longer accepting online orders in this stock. I tried calling them, and that's when E-Trade had said, we are not allowing orders in AMC or GameStop at the moment. Thanks and goodbye. So, everybody's wondering, is this to protect the hedge funds that were short, these hedge funds that were losing money? Everybody knows this is the huge pain trade, as they put it. A pain trade is when a lot of hedge funds on the street are all feeling it because they all have the same positions. So everyone's feeling the pain, and the pain just gets exacerbated because as you're short and as you're deciding, okay, I've got to buy this back because, remember when a short position, you can lose, sky's the limit on the loss. If you're short and you just sit there like a chooch and don't buy your position back because you're like, no.
What's a chooch?
A chooch? My mom used to say chooch. Chooch, it comes from an Italian word chuccio, which just means like an old donkey, like an ass, like a moron, like a chooch. Yeah, he's a real chooch, is how she would say it. So if you're gonna sit there like a chooch, you could potentially lose everything, but of course things are set up that you lose a certain amount and somebody will come step in and be like, okay, you didn't buy these shares back, you have lost way too much money, we're doing it for you, you're out, whatever. So the point is, that's the problem with shorts. The sky's the limit with the amount of losses on shorts. Whereas if you have a long position, if you buy $100 of Apple, you can't lose more than $100 if it were to go to zero. But if you were to short $100 of Apple for $100 and Apple could trade as high as like $5,000 a share and you would lose $4,900 a share. Like, I think that's something that people forget about, that it's like the losses are, they're infinite. So anyway, so that was what was going on, and everyone thought, oh my God, they're restricting trading because a lot of this buying, is obviously from the hedge funds who are being forced to cover their positions. And I'm going to get to that in a second when I say cover their positions. But a lot of people thought, oh, they're buying because, or they're restricting it because they want to mitigate the buying pressure. They want to remove the retail, the day traders, the Redditors. They want to remove all the buying that is forcing, GameStop even higher and causing more pain for these hedge funds. NPR and all these outlets are saying there's all these class action lawsuits. Well, I read a Barron's article yesterday about it, and which I think makes perfect sense. And basically, without going into too much detail and keeping it simple, when you do a transaction, when you buy shares in the market, even though your platform might look like, oh, I just clicked buy at that price, and all of a sudden, now my portfolio shows I bought those shares, and then, if it's for $100, I bought XYZ stock for $100, and then $100 went out of my cash balance. Makes sense, right? Well, sure, but then, in the real world, that money needs to go out of, the E-Trade's account, and it needs to make its way to the seller's account. And that's all done through DTC, which is the Depository and Trust Clearing Corporation. So DTCC makes sure that any shares that you bought are going to come from all the accounts of the seller shares and make their way into yours. It's a 2-day settlement process, and the cash settles in 2 days. Now, DTCC is happy to do all this, but they require collateral from each of these platforms, right? So there's a certain amount of collateral, and these collateral calculations are based, now I sound like Nancy Saltman. Stay with us. Sorry, that's for another video. Nancy Saltman from The Vow, HBO's The Vow. Crazy. So what I was saying about collateral, the DTCC requires a certain amount of collateral to be posted just to make sure that this cash and that the stocks that need to move are all going to be moved, but the cash especially, they want to make sure that they've got this collateral there just in case something were to go wrong, right? So the problem with that is the really risky names require more capital. So GameStop, because it was all over the place and because there was so much buying in the stock, they were sort of out of balance, because when you buy, if Robin has a bunch of buys and a bunch of sells on a day, usually they have the same amount. But if a lot of people are just buying through Robin, and maybe they're selling through E-Trade or other things, or whatever. But if you're buying through Robinhood, they're only seeing buys. That's a lot of cash that they are on the hook for collateral wise, and the collateral requirement is much higher because GameStop is a much riskier stock than say Apple, where a collateral requirement would be much lower. So that said, Robinhood and I guess E-Trade, it got to the point where I think I read where the collateral is usually like 25 billion and they wanted 35 billion, something like that, something where it was like 40% or something more collateral than they usually post. And so Robinhood was simply like, we don't have that collateral, we can't do that. So we're just gonna restrict trading in it. That's why they restricted the trading in it. That makes sense to me. I'm sure that they need to rethink a bunch of things, but I think at the end of the day, there are a lot of conspiracy theories, and it really isn't all that complicated. It really just came down to money, and it came down to them having to fund this two-day settlement of cash. So they couldn't fund it anymore, and they stopped trading in it. And the other name was AMC. They stopped trading in that. It was the same situation. So that's all there is to that. I'm sure we'll find out more as this thing unwinds. There's a lot of people that have said like, oh, is it foreign? We're foreign, investors, or were foreign entities involved? Or are they trying to manipulate? Oh, that is another thing. Actually, there's two things I'm going to end this with. Market manipulation. That is against the law, right? And this stock was manipulated.
Could you describe real quick what market manipulation is?
So market manipulation is when you try to manipulate, or manipulation of a stock price is basically manipulating a stock price with ill intention. So, for these people these Redditors and Wall Street Bets to get together and just, obviously it's all in writing, and there's going to be a lot of proof to see who were the real culprits and who were the ones that drove this manipulation. But yeah, you can't manipulate a stock price. You cannot go out there and put out false information. You can't tell people, let's do this to screw the short sellers. Come on, everyone, let's do this, because you are manipulating it. You do not have good intentions or honest intentions as far as buying and selling, and you need to have those. And there's a lot of criteria, and I don't work for a regulator, and I would never want to. But I can say that this is a clear-cut case of market manipulation. Maybe it's by a bunch of people, and maybe they're not going to go after them because it's like, Joe Schmo on the street, and they're like, let's not go after the mom and pop investors. But maybe they will. I don't know. The law is the law. I believe you break the law, you can't just pick and choose who you're going to go after. So one thing I think is important to, and I'm going to add it into this because it I didn't mention this about the short selling. There are 4 transaction types when you're day trading, right? So you'll see that there's buy, there's sell, which is what probably most people use, because not most, I can't say most, but a lot of day traders and retail do not short, but they can short, and they do. I certainly do when I think this thing is way too high. And I don't care if anyone tries to come for me, because it's actually, it really does provide, hedge funds provide liquidity, and so do retail. Day traders, we short sell as well. It provides liquidity, it keeps bubbles from happening. It's not the way that people like to perpetuate it because they don't understand. You sound like a great big dummy. You're like, these hedge funds are so bad. They wouldn't even go under. They want everything. They wanted to go bankrupt. It's like, no, they short sell because it's trading up at 1,000 and it probably should be trading up at 900. You know what I mean? It's not like, it's like saying, it's like being angry. Oh my God, you bet against the Redskins? What do you want them to leave the NFL? It's like, no, I think they're going to lose this game. I think they're having a bad year. You know what I mean? Like, they shouldn't be up here. They should be here, sort of. So anyway, that's what people need to remember, number 1. Number 2, that there are 4 types of transactions. There's buy. If you were to go and buy 100 shares of Apple, you're going to click buy to do that transaction. If you want to, the next day or later on that day, sell any of those 100 shares, when it asks you transaction type, you're going to click sell. However, if you have 0 shares in a name and you want to secure some borrow from Ted so that you could sell it to Lucy and go short, that is a sell short transaction. And you will see buy, you will see sell, then you will see buy to cover, and you will see sell short. Buy to cover is basically when you are negative shares because you sold short and you want to realize your profits and you want to, the stock has come lower, or maybe stock has gone higher and you want to cut your losses, whatever, but you want to get out of this short position. That is a buy to cover. So I'll tell you this, one time I shorted something, I shorted a stock, say Intel, and I went to, then I realized, you know what, I don't want to short sell this stock anymore. I want to buy it back, or cover it, as they say. Well, guess what? Instead of clicking buy to cover, I clicked buy. And what that did was I still had a short position, which I was paying a borrow fee on, which I talked about in my last video. I was still paying a borrow fee in the short position, and then I had a separate long position. So it was like I was long 100 shares of Intel, and then I also showed I was negative 100 shares of Intel, as if there were two totally different positions. That's because I didn't click buy to cover. If I clicked buy to cover, my negative 100 Intel would have gone to zero. If I bought 100 shares to cover, it would have gone to zero. So just remember that, because you don't want to end up paying fees that you shouldn't be paying. Make sure that you know what each transaction type is and how to use it. That's it. I'm done. I'm going to stop screaming my fat mouth off. Goodbye and good luck, and click subscribe so I can get to 100 subscribers, y'all.